Hello, folks. Welcome to the Weekend Investing Weekly Review for the week ended 2nd of May. Eventful week. Markets keenly awaiting the outcome of what Indian forces are going to do about the border conflict. Also awaiting the confirmation of US-China talks to start. There are a lot of rumors floating around, but not yet there. Another one is President Trump's diktat on anybody who deals with Iran will be subject to sanctions. That is another new sort of tangential fire from the White House. So a lot of things happening. Markets are very stable. I think markets are just waiting and watching and allowing all this noise to go by. From our research desk, we had these fantastic stories to share with you. They are available on the blog, on the newsletter, in the Weekend Investing app. Please go through them. It's a lot of good learning there. Disclaimer as always, please read it fully and do subscribe to the channel. Nifty this week, 1.28% up this week. This is actually a daily chart, but you can see that from last week we are up slightly. We've taken a support at the previous highs, which is a very good sign, but unable to go higher this week. Today also, for Friday, we had a nice bump up, but it succumbed to market pressures. Uh, this is the weekly chart. You can see we're now 4 weeks up on the trot, which is always a good sign. Tells you that there is some strength that is coming back into the markets. S&P 500, another sort of amazing chart where 2.5% up on weekly this week as of 8 p.m. 2nd of May. The point to note here is that US just posted a first quarter negative GDP print and the market still wants to go up. That is telling you, how invested this market is in terms of rate cuts and perhaps QE kind of a situation coming very soon. Um, in a normal market, on a surprise GDP negative print would have fallen like crazy, but that's not happening. So if we follow the price is telling us that the market is already discounting that news and is looking forward to aggressive rate cuts um, for the US markets. Gold has been smashed down this week. On the weekly chart, gold is not looking very pretty right now. It's down about 3% this week. Of course, the run has been phenomenal. We've gone from uh, 52,000 or so since October, November 23 to nearly 93,000, and in the current calendar year also from nearly 74,000 to 94,000. So the run has been more than what usually we get in gold. So uh, some one would say some consolidation, some pullback, some reversion to the mean is always good. So maybe we'll come back to 90,000 or so, and that probably is a good place to sort of buy there. Dollar index is not weakening as one would have expected after the 100 support giving away. We're still at 99.5 or so. That move downward, if it happens, will cause a lot of emerging market flows and potentially positive for India. But right now, that is not happening. On the other hand, despite dollar index not going down, rupee has been strengthening very hard, and that's good for India oil import and the capital account, but of course not so good for Indian exports. The benchmark indices, um, 1 week we have had Nifty go up. So primarily one can say that the large caps have led this market this week. Nifty 500 up 0.72, Nifty 50 up 1.228, and mid caps and Nifty next 50 also, although large caps have been subdued, and small caps have seen a reasonable correction of 1% this week. The sectors this week that have really outshone is defense, 6% up, oil and gas 4.4% up, infrastructure stocks 2.4%, and real estate 2.6%. These are the four sectors that really stood out. There's not any major loser in terms of the sectoral change. In the sectoral momentum score, we find that defense is right at the top. Private banks next to that. Banking in general third. Financial services is slipping right now, but still in the fourth rank. And services sector in the fifth rank. Oil and gas, you can see, is coming up in the short term. Capital markets is giving up in the short term, and autos along with infrastructure stocks, real estate, IT, also very sharp short term movement in the last 1 week, although longer term they are still in the red. So it's a sort of a relative change of sectors in the short to long term that you can see in this chart. In the weekly advanced decline stats, you can see that uh, the advances were muted, especially in small cap, mid cap, and micro cap, 7 to 23%. In Nifty 50, we had 38% advances and 62% decline. So the bias remained with the bears, despite the price not really going down. The percentage of stocks outperforming the benchmark remained very low, so nearly about 20% odd on all indices, which is very low. So basically, 80 odd percent stocks are not performing better than these indices, which is a poor sign. The major drop from 52-week high statistics remains the same, where we have uh, Nifty Next 50 losing maybe 10 to 40% mostly, mid caps and small caps losing 20 to 40, 20 to 50%, micro caps losing 20 to 50% again, and Nifty basically losing mostly between 10 to 30%, or even below 10%. Actually 34% are below. So it remains a very uh, I would say a lopsided market, where large caps are lesser damaged, and small caps and mid caps seem to be more damaged, and micro caps of course are the most worst hit. Is the trend improving or declining? So how many stocks out of CNX 500 are actually above the 200 DMA is being shown by this blue line, and that has been declining for the last few weeks. So only 27% of CNX 500 stocks are above 200 DMA, so that's a very poor score. And also 55% stocks are above 50 DMA, which is also a reasonably poor score. Anything below, I think 60-70% on 50 DMA is a poor score. And there seems to be a complete lull in terms of uptrends. In the trend check, you have, and let's do a 200 DMA trend check. We have financial services and private banks, which really stand out in terms of 70% and 60% of stocks in these sectors being above the 200 DMA. Rest all sectors are below average, below 40%, and many sectors are actually even at 20%. Metals, energy, PSCs, oil and gas, IT, and real estate are at 10%. So of the last tail, these 5 6 sectors really have very poor breadth in terms of number of stocks above the 200 DMA. So, so the statistics is not painting a very bright picture as of now. The FI flows have been positive since 15th of April, and that is probably a very good sign that we are seeing, and that is probably why our markets are sustaining. Is that both DIIs and FIIs have been on the buying side. DII is a little bit on the selling for the first week, but on the last 4 or 5 sessions, DIIs have joined FIIs on the buying side, and which is a reasonably positive sign. In the cumulative FII DII statistics, you can see both DIIs and FIIs have bought in the last 30 days. So DIIs have bought 38,000 crores, FIIs have bought nearly 20,000 crores. So there's net buying from institutional side from both the sides of this institutional game. So overall, the market's pricing is stable. FIDI is on decent footing. The momentum or the trend is yet to really pick up. You have a lot of stocks which are below 200 DMA. And somewhere near the current level, if we are able to consolidate, form a base, and if some of the problems of the world currently, which is basically the tariff issue, get solved and we get a good monsoon, I think we are set for a better second half of the year. Let me know your thoughts in the comments and do share these videos. Thank you. Bye.